Everyone, welcome back to the Capital Mindset Show. Today we're going to be kind of discussing a little bit about what's going on in the markets as well as a portfolio update. And you should look down in the description below if you guys are new to the channel. Here on Capital Mindset, I share the portfolio here for free, no paywall. I do not share the amount, okay? So just be aware of that. That's for privacy reasons for me, myself, and my career. I don't want, prospective employers knowing my net worth or anything like that. So the most important stuff is included in there, and I'll actually be showcasing it here, kind of making some commentary. I'm going to be filming quite a bit tonight, so I'll see. I'm going to get some subscriber requests in. Wanted to update you guys because so much happened this week. If you guys have any questions on the stuff that happened this week, feel free to come on the live stream. I'm going to be doing a live stream on Friday, so 4/15/2022, as always, and be sure to ask me as many questions. I might even do a live stream also on Sunday at a completely different time period so that it gives everyone a fair chance to ask questions live, because I know everyone's in different time zones, and I really do appreciate all my subscribers regardless of where they are in the globe, so I try to be accommodative when I can. All right, so on that note, I actually want to share this with you because we had some banks report this week. We had Wells Fargo. I think Wells Fargo was today. We also had Goldman Sachs. We had JP Morgan Chase, I think was yesterday, and off the top of my head, we also had Citigroup as well. But there's a common theme here, and I'll actually share that with you guys right here. So here we have Wells Fargo shares fall as quarterly revenue misses estimates on weaker than expected mortgage lending. All right, so let me just explain basically what is the implications of this, okay? Because we all know that, for example, housing prices have gone up, and I'll actually share with you guys Wells Fargo's stock price. So we're actually down about 4.51%. And, for those of you who've been following me for a while, you guys know that I sold the banks last year, okay? So I took my profits because there were always these questions when I first revealed the portfolio. Well, why is Citigroup in there? Well, Citigroup, again, is the only one that remained in the portfolio because I had, just a speculation. It's such a small part of the portfolio. It really isn't a full-sized position by any stretch of the imagination. And it was on speculation that the management team might turn things around. I had taken profits off of my favorite banks, which was Bank of America, JP Morgan Chase, and Morgan Stanley, as well as Charles Schwab, but that's a separate note. So there's a little bit of a preparation and a little bit of nuance, right? And Wells Fargo, I did flirt with us, actually, by the way, because you guys might have been like, didn't you also say Wells Fargo? It's like, yes, also Wells Fargo was in the portfolio, but that was more of a flirtatious position because I thought the bank had been beaten down too much. So what's been going on? Well, we know that, again, this is actually going back to that term you guys are probably annoyed with me saying at this point, but the liquidity crunch, right? So it's still an ongoing process, and it actually takes some time. And I've stated this in videos and responded to comments in videos about banks because some of you had very good questions, because a lot of people do believe that. And I think if you listen to financial media, they do oftentimes repeat the statement that during high or rising interest rate environments, that is better for banks. The answer actually more becomes it depends. So for those of you who didn't see those videos, I will rephrase it here. And if you didn't read those comments, that's perfectly fine. I just want to give you guys as much information as possible. And let me know, by the way, if it's easier to digest. I try my best, but in essence, it's depending on the situation. And that's oftentimes the lesson I try to derive or try to instill in everyone is mixing up macroeconomics and investing can be very difficult, because oftentimes with macroeconomic predictions and also sector-wide predictions, you often can overlook one key detail. And that one key detail actually makes it different from a previous situation or scenario that happened in the past, and you're using that past scenario to derive a prediction into the future. And so that can mess it up, especially if you invest accordingly. Okay, so with rising rates, a lot of people, and again, no fault of you guys, I think I know that CNBC and other credible news outlets do say those statements, right? That, oh, rising rates, this is good for banks, because intuitively you think, oh, they're generating more from interest. And I stated in those videos and to comments that not necessarily. You actually do need to see some lending growth, and so greater activity. And lowering rates can actually be better for banks in a lot of instances, especially when you factor in QE and being a primary dealer and all that jazz. So a but a company that would actually do good, and we'll actually review one in the portfolio because I do have exposure to that, and I've stated and I said to you guys, this is my exposure to rising rates, is actually insurance companies, because insurance companies have to invest their float. And I'll actually just take this away for now so we don't have that distraction, but insurance companies invest the float, and they actually benefit the most from rising rate environment because they have a liability. They have a set amount of liabilities, and they need to either pay out less than what they get in, right? So they have to have a positive premium, or they could generate income on those premiums. And I think I have a video on the channel going over the insurance sector where I go a little bit more in deep. And I think the company in question that is the case study in that video is Chubb. So if you find that video, and in fact, I might put a link down in the description, the video. Actually, hold me up to it. I'll put it down in the description if you guys are curious about that. But in that video, I go into how to evaluate insurance companies, and a key detail is the float. So again, going back to Wells Fargo here, we see this drop here because lending is going down. And by the way, in case you guys didn't know, because some people don't know this about the banks, Wells Fargo, of the big boys, of the big four, they are the most exposed to mortgages. A lot of people don't know that. So Bank of America is the one that has a lot of exposure to oil and gas. Wells Fargo has a lot of exposure to homes or mortgages. So by far, they have the biggest balance sheet dedication to mortgages. And so when we find out, oh, it's coming down, lending growth is going down, that's not good, right? Because Wells Fargo needs that lending growth to increase. And remember that they're loaning out your money, right? So you're a liability. When you put your money into Wells Fargo, you're a liability, and they got to go out and turn that liability into an asset, typically by acquiring, an asset for them is lending out money, right? A bond or mortgage-backed security, et cetera. But yes, the banks in general, they're kind of, So that liquidity crunch word, we're still in it. We're not totally off the hook. When we're finally off the hook, I'm going to definitely be adding to my REITs again, and maybe even some banks. So I'm putting some banks on a watch list, and actually I'll showcase a stock that I'm actually looking at. Truist Bank. This is an actual merger between SunTrust and BB&T. And I want the stock, guys. Come on, Google. You just need to predict me. All right. So we can see like Truist is actually down quite decently from its highs here. And this is, I think, pre-merger because it merged very recently. Because this is, I think, going off of BB&T. Don't quote me on who it's going off of. It might be going off of BB&T's. Yeah, but I don't know whose stock price this is really. But the point is, more recently, it actually is coming down. So I'm looking at, this is a regional/national bank. It's kind of like an up and coming. And, who knows, maybe Citigroup gets dethroned by something like this. I wouldn't say it's impossible, but, it is unlikely right now, but it's not impossible. I think Goldman Sachs, let me see what they reported. So GS. Goldman Sachs actually did report a good earnings, but the problem is they made money from the volatility. So these banks, these investment banks, a lot of people don't know that volatility is actually really good. So JP Morgan Chase, their investment bank arm, it's really good. Also a bunch of IPOs occurring. Also, all that's really good. But we did see Goldman Sachs has come down from about $400. Now it's down to $300. So it's reflective of the overall health of the economy, right? Of the concerns that we've been seeing. And I think now it's becoming very, very popular to say that we are going to recession. I think Jamie Dimon says, now it's very possible. But, if you're watching this channel, or if you're watching other channels, or you're very stout, or you're kind of a fanatic of either finance or economics, you probably already know that it was to be expected. Now, again, like I state on this channel, I will never state here definitively how big this recession will be, but I wouldn't be surprised if we go into one, right? I won't be surprised if we're technically in one but don't know we're in one yet at this very moment. Again, because I already expressed why this might be. If we have energy prices, food prices rising, this actually crushes the consumer and doesn't allow them to spend as much money into the economy. And remember that the United States economy is primarily a consumer-driven economy. So, big problem there. We're seeing lending growth kind of slow down, rising rates. Again, not ignoring if you're Snyder-pilled or not, but rising rates are not good so much for home lending. So I'm actually excited because I really want to buy up some properties. And at least where I live, I don't know where you guys live, because I know I have a global audience here. I mean, I look at the analytics. I have a global audience here on this channel. I don't know if that's normal for all channels, but Capital Mindset's audience is pretty global. I'll say that. So I don't know where you guys are at, how your territory is, regarding property values, but where I live, it's getting pretty crazy because we have a quasi-American refugee crisis, I call it, an economic refugee crisis from New York and California, and they're all coming here, and they're driving up the prices. It's too many people trying to come into a small space. But anyways, let's actually get into the portfolio. And again, this probably might be too long for a lot of people, this video, but for those of you who like these longer videos, I hope to make you guys happy with this. But I'm going to be going over some of these positions right now in this video. And I might separate this video into smaller parts. I haven't decided, and then just release those parts separately. But this portfolio now is updated. And you can kind of see that the weighted gain has dropped significantly. And that is actually because I've sold big portions of some positions and I'm done selling them. And that is I sold BHP and ConocoPhillips. I sold and I'm done. All right. I'm not selling anymore. ConocoPhillips is finally, and it's been a while since it's been updated. I think it was updated last month. So we did sell most of the shares above $100, so I'm very happy about that. And I'll actually talk about why I started to sell. And let me actually zoom in because I know some of you watch on your phone. So ConocoPhillips, some information has been coming out that United States, remember I said United States is like the sleeping dragon when it comes to oil production. At any moment, things could change. And this was months ago, especially when I made the first oil video way back last year. But it's more or less happening now. So a lot of oil production actually is coming back online within the United States. And so that's my cue. When everyone's kind of bullish on my asset, I'm going to sell it to the really bullish people that think, oil prices might continue. And it very well might, okay? I don't have a crystal ball. I just don't like that proposition for me, and I'm very content with the returns I've generated in that portfolio. So the returns have been over 200%, almost 250% for ConocoPhillips. Some of those shares I did get over a sale price or a sale return of over 250%. So I'm very happy with that performance. That was very good market-beating performance from that position. And then I'm going to be redeploying that capital into other things. I haven't decided yet. Who knows that maybe the real estate market does come down and I can use those gains and buy a house. Well, some of those are actually in a retirement account, so I can't take those out. But regardless, we're not really discussing the nuanced details there. Netflix has been added to. You might see that Netflix's average cost has been coming down a little bit. So add a little bit to Netflix. Let's see here. Oh, there it is. Citigroup is right there, like I said. So I'm still actually up on Citigroup, but again, it's the only reason why it's in there is it was like kind of like the ugly duckling of the banks. I had the other banks, but I liquidated those. I've already had this conversation, but regardless. The one I want to focus on today is Cardinal Health. So Cardinal Health will actually do an analysis of it right here. And we actually had very good performance on Cardinal Health. So my average cost is about $47.31. We are currently up about 33%. And yes, I'll explain the thesis behind it in going into the valuation, but a little bit about Cardinal Health. So Cardinal Health distributes medical supplies, equipments, some small pharmaceuticals, etc. But what you got to think about is distribution of medical supplies. And Cardinal Health is a dividend investor favorite. I think a lot of people like Cardinal Health in that community. Maybe it's not like everyone's favorite, but you have a triopoly with Cardinal Health, AmerisourceBergen, and McKesson. McKesson is the biggest. AmerisourceBergen, I believe, is the second biggest, and they have a very strong relationship with Walgreens because Walgreens actually owns, I think, 30-something%, around 30% of AmerisourceBergen, ticker symbol ABC. And then McKesson is MCK, by the way. And Cardinal Health, ticker symbol CAH. CAH actually has a huge relationship with CVS, okay? So there was a fear that Amazon was going to come in and, topple something like Cardinal Health. Now, actually, the caveat or the plot twist to that, and this was actually my suspicion, one of the reasons why I did actually take a position was a lot of those fears were overblown. People were maybe attributing too much of a danger to Amazon to their business model. And so I decided to take a position as well as the valuation. And I think this video is a long time coming because many of you have asked me for a video on Cardinal Health because you've seen it in the portfolio. And actually, I'll take you guys through that here today. It's better late than never. I'm so sorry about it. But so here we are. We're at Cardinal Health. It's already plugged in, was waiting for us. And ignore this 18%. I never modeled it that it was going to grow at 18%, but I had a very good discount rate on it, discount rate of about 20%. I did assume that they were going to actually repurchase some shares. On the growth metrics, you can kind of already see that my average cost, let's go back to revisit that, my average cost based on the data that we see in terms of the financial statements was $47.31. And I could have assumed around a 1% growth for the next 10 years, which is basically stagnation. And I had a favorable prospect for great returns. Okay. So I thought at the time that it was a very good valuation. Now, the question then becomes, what am I going to do with it here today? Well, I still think that Cardinal Health is at a decent valuation. It's not as bargain basement as it was before, but it is still at a decent valuation where I still think there's a high likelihood it does still outperform the market. So because of that, I'm not yet liquidating the position. I'm going to maintain my position in Cardinal Health. I do believe that the business has a strong moat. And, I'm also getting some nice passive income, you could say, from it. But it's a good size position. It's a good size of passive income. I can't really complain with this position. It was I think, in my opinion, hindsight right now, it was a well-executed position. So let me know if you guys have any questions down below. Again, questions more directly that can be asked, live. We'll go to my lives, and then I'd be more than happy to ask a question. Don't forget to do the super chats with. No, I'm kidding. I'm just joking. But we have a joke in the community when we do the live streams that they just type a number and then they put a $sign and then that's a super chat, just for context. All right, so taking a look at some other positions, like we've been talking about Thor Industries right here. So Thor Industries is actually down in the portfolio about 3.55%. Like I said, if we do see a slowdown in the consumer, there's a position on that side of the portfolio that is, I have to point which way? Yeah, that way. It's mirrored, so I gotta go. It's that way. So on that side of the portfolio, there's a position that actually counterbalances Thor. And so with that being said, Thor will actually be harmed if we do see drawdown in consumer spending, which is a very real possibility, especially now. So when I did the Thor video, maybe some of you thought I was being a little bit overly bearish on Thor, even though it is a newer position within the portfolio. But do remember that I like to focus in on the risk factor more so than anything. And in fact, with Thor Industries, I stated that I might have been actually, and it's still early enough that I can actually trim it, but I'm fine because what I don't show here is like my cash position, so I'm fine. But Thor Industries is a company I do want to add to on any weakness. I think that the market might be already pricing in a lot of that weakness. I want to be very clear that is a real possibility. But we'll see. Taking a look at other positions like 3M. 3M is, nothing. I'm not adding to it anymore. I'm kind of holding it because I started adding to this Magna International down here. And we are down about 5% on Magna. But Magna is one that I have a long-term plan on accumulation. So it's perfectly fine. I actually want it to come down a little bit more. I already made a video on Magna. Go check that video out. And taking a look at some other stocks that are kind of finally happy with, and I'm finally getting some good performance on is Molson Coors Brewery. I've been waiting on that one, but I can't complain because it's I think for Molson Coors Brewery, it's not even a 1 year position, and we're already up about 21%. So for 1 year return, that's not too shabby. I think I'm very happy with the performance so far. It's just evidence that a lot of times you have to show patience, and after you do the homework, you kind of buy the asset. You let it sit, okay? You've done the homework, you let it sit, okay? And then having a diversified portfolio mostly helps with psychology, guys. A lot of people underestimate this. Of course, for example, I would be much better off with picking like 5 amazing stocks, right? Obviously, some of these stocks are going to perform better than others, but kind of having these different positions at different sizes kind of eases one's mind because some stocks will go up sometimes and some stocks will go down sometimes, and it depends on the performance of the business, or maybe the sector's having a troubled time right now. So you can kind of reshuffle things, hopefully, and hopefully you're doing the right decision on that front. Easier said than done. I still have to make the video on Avi, but I can discuss some things on Avi. Avi, the president, actually just recently retired. Avi's been a very good performer. This one's all in long-term capital gains. The dividends I'm not reinvesting in anymore. I'm actually taking those dividends, piling them up Yeah, Rio Tinto I'm not selling, so that's a mining stock that I'm not selling because I think there's still a little bit more value to be realized, a little bit. BHP, I did sell BHP, sold it down a bit. You can kind of see here that now it's at 0.72. So it has been reduced. And again, you can kind of see that ConocoPhillips, when I realized those profits, it drew down the weighted gain of the portfolio quite significantly. So I am keeping the rest of the ConocoPhillips position. That is staying. So it is now significantly reduced. It was close to 10% of the portfolio. Now it is down to 2.35%. And again, varying amounts in terms of retirement account, but that's a detail that doesn't matter. Taking a look at, I already told you I added to Netflix. Markel Corporation, fantastic performance more recently. So, all of a sudden it just kind of did what it did. Can't really say anything to that. Amazon was below 2,000. I'm not really doing anything with Amazon. You can kind of see like some of these positions when I sell them down, I like bring them down to like 2%. I don't know why. It's like some weird thing. I just noticed that I do that. Oh, this is the one I wanted to cover with you guys, Unum Group. So Unum is a stock that's been in the portfolio for quite some time now, and it's performed very well. Fantastic. I'm very happy with the performance thus far. And Unum's up about 78%. Can't complain with the performance overall. It is one that is benefiting tremendously from rising rates. It's an insurer, and it's a very discounted insurer. I mean, Markel's another insurer, by the way, for those of you who didn't know about Markel. Markel's like a mini Berkshire Hathaway. I'll briefly cover the speculative side, but I don't really like to cover the speculative side because some of these are microcaps. So I'm going to teeter on the don't really want to talk about it. But look how much I'm getting absolutely destroyed on the speculative. Well, I'm actually not getting destroyed when you weight them. When you weight these, I'm not getting destroyed at all because there's one position there that I don't like to talk about at all because that is like that's a small company. Okay. Obviously I'm pointing it out because, but I'm not gonna, I don't want to ever be thought of as someone trying to hype something. So, but anyway, so Overstock is down again. This is very volatile stock. So if it comes down more, then I'll keep adding to the position because I still believe in it. It is still a speculative stock. If it makes it into my portfolio, except for a couple stocks, if it makes it into my portfolio, it is something I do believe in. I do believe that it is worth putting my capital into. And just because it's speculative does not mean that, I think the company is going to go bankrupt, nothing like that. There's a couple stocks in here like BurgerFi. BurgerFi is just a fun stock. And that's about it. I've been lowering my average cost, but this is a stock. Let me just show you guys. This is a really funny stock. So I can only imagine if someone makes this like a huge holding and how much they've been like crying the whole time. So yeah, it IPO'd here. It had like this SPAC moment where it's up and down, up and down, up and down. It IPOs at like $15 a share, I think I remember. And then it's just like down and down and down and down. So let me see from where it is. Yeah, it's like down 74%, something like that. But I don't know. It's at a market cap. Like here, I said I wasn't going to highlight market caps, but like I'm clearly like not, saying, oh, go out and buy the stock. Clearly not. It's $85 million market cap. Very small company, headquartered, I think somewhere in Florida. But I really like their milkshakes. I enjoy going there occasionally. I haven't been there in a couple months. Maybe that's why they're down. They need some of my business. So that'd be funny. I'm gonna go there and then like the stock is just gonna shoot up. All right. Anyways, being serious, back to seriousness. Greenwich Life Sciences. That's another one that's like I'm not gonna really talk about it too much, but it's entirely just it's cancer research. It's like a hit it or miss it. If it goes to zero, wouldn't even care. Would not even care. Would not affect me. Foot Locker was already sold in the position. Again, I keep everything that I've sold as well, just so everyone who's like newer to the channel can come in and see, okay, he's done this, he's owned this in the past. These were like the gains. It hopefully helps a little bit. But yeah, that's basically what's happened there. Tencent was switched out for Prosus. Prosus is now is basically Tencent Lite, and Barbecue Holdings is doing really well. Zillow Group, I'm hoping it comes down a little bit so then I can add to the portfolio. And you see someone actually, well, you guys can't see that, but someone actually is watching this portfolio right now. So always I see when I come in here, someone's watching it. So, but anyways, Corsair Gaming is actually still in there. I haven't even sold Corsair Gaming, but Corsair Gaming broke below $20. Interesting. I'm not really paying attention to that one. Alibaba is now back down under 95. So now this video, again, I'm going to maybe get into the Chinese companies a little bit, because it's not a dedicated video. So I'm still keeping to my promise that I haven't made a dedicated video to it. But Alibaba and Tencent actually kind of collapsing here, because China's actually been making some interesting restrictions to capital flows. And also we have the lockdowns and potential, exacerbation of recession within China. I know that they're doing some interesting things with their banking system. I know this because a very dear friend of mine works at a Chinese corporation, and they've been telling me some very interesting thing that's going on. They actually work out of the United States, and they're not getting paid right now because money's not flowing out of of China for some reason, with something going on with their banks. Very interesting stuff. All right. And we also have, of course, the Charlie Munger thing, which I already made a video on, but Charlie Munger has sold Alibaba. We don't know exactly why. And for those of you who are new, I own Alibaba for two reasons. I own Alibaba for reason number one, because every time I criticize Alibaba, I don't want anyone to think that I cherish or relish in the fact that I don't believe in that the fundamentals are absolutely connected with the stock because of the whole blah, blah, blah VIE thing. And number two, because I think it is a heavily sentiment-driven stock, I think it's very evident right now. It is very evident that it's mainly sentiment driven. And right now, I do think that the sentiment is very negative, and thus a position now maybe makes sense in kind of like a greater fool theory that I'll sell it to someone else at a higher price. I'll sell it to someone at a higher price. And then I sold 10 cent for Prosus, took that tax loss, harvested that tax loss because why not? And then actually with my thesis that it's sentiment driven, believe that something that's a foreign asset will actually benefit more than the domestic, or not the domestic, but the domestic representative of that asset. Okay, so that's kind of like the thought process behind that. But yes, that's more or less going over all my portfolio and a little bit of some macro concepts or macro talk. I'm actually really excited to see what happens in the housing sector. Again, I do think that housing might kind of get a little hurt from this mortgage lending that we are seeing slow down. I don't have any exposure to home builders, but if I was exposed to home builders, I would be a little bit concerned right now. I haven't made a home builder stock video, and I should do that, but it's just the timing, guys. I'm trying to balance everything. And what else? Is there anything else here that I want to talk about before I let go of it? Brookfield Asset Management, I sold out of that one. We're seeing Activision Blizzard now. It's definitely below $80. It might be an interesting arbitrage if you think that acquisition is going to go through. The acquisition is for $95 a share. So Activision I sold after the day of that, actually, that it got announced they were being bought by Microsoft, and I was able to exit my position at very favorable prices. And again, I made a video on the concept of understanding the difference between absolute return and time averaged return, yearly averaged return. So I think that's very important nuance to understand. And I think that covers almost every stock that I really wanted to talk about. Again, if you guys have any questions, ask or comment down below. I'm more than happy. If you want a question answered live, feel free to come on the lives. I'm going to have a live stream tomorrow, Friday, 4/15/2022. The time, I'm not set on a time, but hopefully around 7 p.m. Eastern Standard Time, United States. Okay, so on that note, guys, I hope you guys enjoyed this video, this quick update. Well, it's not a quick update at this point. I think it's like almost a 30-minute video, but I hope you guys enjoyed the update. And on that note, I'll see you guys in the next one. Bye.